Jack Dorsey predicts hyperinflation, while Cathie Wood is predicting deflation. Who is right and who's wrong? We're going to answer those questions right now in 3 simple, fast steps. Step number 1, let's go over the definitions. Most people know what deflation is. That means prices going down of the stuff that you buy daily, or the asset prices going down. Some people equate it to the dollar going up on the DXY. More on that in just a moment. But most people see deflation as consumer prices going down over time. But many people get confused when we start talking about hyperinflation. So let's go over that term specifically. Also, some red flags that we're seeing right now in the United States that could point in the direction of Jack Dorsey being correct. So editor, let's go ahead and cut to a clip of Investopedia where we get the definition of hyperinflation.
Hyperinflation is an economic term describing rapid, uncontrolled price increases. During periods of hyperinflation, the real value of domestic currency erodes at a rapid rate. Prices increase as people who hold the currency seek to get rid of it as quickly as possible because they know that the cash will not purchase as many goods tomorrow as it does today. One cause of hyperinflation is when, during a depression, the money supply expands rapidly without a corresponding economic expansion. This creates a large supply of money with little demand for it. The currency then loses its value. Hyperinflation is also caused by political instability and war. Currency loses value because people lose confidence in the government that backs it. Some people even switch to a more stable currency from another country. Sellers require a risk premium to be enticed to accept the currency. The risk premium is reflected in higher prices. A number of countries have experienced hyperinflation throughout their history, including Brazil, China, France, Greece, and Poland. In 1994, Brazil had an inflation rate over 2,000%. One of the most famous periods of hyperinflation was in Germany during the early 1920s, when hyperinflation reached a peak of almost 30,000%.
Did you notice what they said in that clip? The first thing is a society is creating more currency units than goods and services. So the amount of currency units being produced goes up, while the amount of goods and services stays flat, if not goes down. And that's something we see playing out right now in the United States. They also mentioned Gresham's Law. And this is basically when people have cash and they spend it as quickly as they possibly can to get any type of good or hard asset that they can use in the future because they know that the price is going to be higher tomorrow, next week, and the month after. But to get into the realm of hyperinflation, prices have to be going up at least 50% per month. 50% per month, not per year. So let's look at what happened in Weimar Germany so we can understand if that's the direction we're headed in the United States, like Jack Dorsey is predicting. And to be fair to Jack, he's predicting this for the United States, but he's also predicting it for the entire globe, for all fiat currencies collapsing at the same time. Looking at this chart, we go back to 1919 all the way to 1923. And this is the price of gold measured in their local currency, marks. On the left, we go from 1. And on this chart, I don't even know if I can count that high. This chart goes to 100 million because I ran out of room. But editor, go ahead and throw up the original chart, and it goes up to, I don't even know, 100 quadrillion or something like that. At a certain point, it doesn't even matter anymore. But what's interesting about this chart, 1919, about 100 marks for an ounce of gold. I believe it's an ounce of gold. And then this basically goes up. So the currency is losing value relative to gold all the way to 1920. But then it kind of flatlines for a period of almost a year. What's fascinating, if you look at the actual year-over-year inflation rate, it was always going up. But if you take a time frame from about March of, let's call it 1920, to maybe March of 1921, the mark actually stabilized. There were a lot of variables that went into the mark stabilizing for such a long period of time. But the point is it flatlined. This was the calm before the storm. So when we go into a hyperinflation mode, the currency doesn't necessarily go down in a straight line. And this chart is a perfect example of that. And I also want to point out the seeds of the hyperinflation they experienced in 1923 actually began and were sown in 1914. So this is 9 years earlier. So these things don't happen all at once, is my point. This process can happen very slowly. And all these contributing factors have to come together in this perfect storm. It's a lot like Hemingway's quote about going bankrupt. It happens very, very slowly. Then in 1923, all at once. So now that we've got our head around what hyperinflation actually is and defined the terms, let's go over some red flags. Earlier, we talked about the fact that during Germany's hyperinflation, in Venezuela, in Zimbabwe, one of the common denominators is that the amount of currency units in the real economy goes up and the amount of goods and services produced either stays the same or goes down. This is something we are seeing right now in the United States. Gresham's Law, we talked about that earlier, but I'd like to share with you a personal story that really highlights the fact that this is happening to a certain extent right now in the United States. This last weekend, I was in Dallas speaking at the Sovereign Man conference with my good buddy Ken McElroy. We're on the plane back, and he was telling me that he is currently ordering supplies, materials for all of his apartment complexes. Kenny manages over $1 billion worth of multi-family real estate. So whether it's refrigerators, whether it's dryers, whether it's washing machines, Kenny says that he is ordering as much as he possibly can right now for even years to come because he's worried about the prices going up. So he rented a giant industrial-sized warehouse, and he's just hoarding all of these materials that he knows he's going to need for his apartment complexes in the future. But again, he's doing that now because he's worried about the prices going up to a significant degree in the years to come. That's a great example of Gresham's Law playing out right now in the United States. And this is another common denominator they mentioned in the clip from Investopedia. But the warning signs, the red flags, and the similarities don't end there. Editor, let's cut to the internet. This is an article from Business Insider where they take a deep dive into the Weimar Germany hyperinflation. They point out that anyone who could get their hands on foreign currency was selling the mark and buying that foreign currency. Now, don't we see the exact same thing playing out today where people are trading in their dollars for stocks, for real estate, and cryptocurrency? Maybe cryptocurrency today is the dollar or the British pound of the early 1920s. They also point out goods were flying off the shelves of shops as people tried to protect themselves against the falling value of the currency. And let's look at this picture. Does this look familiar to you? It definitely looks familiar to me because every time I go into the grocery store, right here, it's my local Whole Foods, there's probably 20% of the shelves that are completely barren. And we also see the exact same narrative from the politicians and the elite. In the early 1920s in Germany, it was a gentleman by the name of Hugo Steins. He was the richest industrialist at the time. And he made the argument that inflation is actually good because it means that we have very low rates of unemployment. And if we were to raise interest rates to combat inflation, then that would increase the unemployment rate, and that would be the real danger to the poor and middle class. And for most of you watching this video, that sounds insane. But we see the politicians and the elite saying the exact same thing today. We look at this tweet that went viral the other day. And this is from an actual economist, I believe, that worked in the Biden administration. He says most of today's economic problems we're facing, inflation, supply chains, etc., are high-class problems. We wouldn't have them if the unemployment rate was still at 10%. We would instead have had a much worse problem. He's literally saying the exact same things that Hugo Steins said in the early 1920s in Germany, that inflation is just the price we have to pay for low unemployment. And at the end of the day, it's better for the poor and middle class to see their prices go up every single day than to actually have fewer people employed. The spin machine was working just as hard back in the early 1920s as it is today in 2021. Although we do see a lot of red flags and similarities, I don't know if I'm prepared to go out on a limb and say that Jack Dorsey is correct about hyperinflation. We're going to explore that question more in step number 3. But before we get there, let's dive into Cathie Wood's argument for deflation. Step number 2. Now let's go over Cathie Wood's argument for deflation. It starts off by believing that velocity is the key to prices going up or down. Editor, let's cut to her recent tweet. And here she's trying to refute Jack Dorsey's argument for hyperinflation. She says, in 2008 and 9, when the Fed started quantitative easing, I thought inflation would take off. I was wrong. Instead, velocity, at the rate at which money turns over per year, declined, taking away its inflationary sting. Velocity still is falling. So what this tweet illustrates right off the bat is, unfortunately, Cathie Wood really doesn't understand how dollars are created. I don't think she understands the commercial banking system, definitely doesn't understand the Fed's balance sheet. Going back to 2008, she thought that we would have this boom in inflation because she saw quantitative easing as quote-unquote money printing. Well, why was that wrong? It didn't necessarily have anything to do with velocity. It had to do with the fact that just because the Fed increases the size of its balance sheet, it doesn't necessarily mean there are more dollars circulating in the real economy chasing goods and services. You guys have seen this picture I draw all the time of the Fed's balance sheet. Right here on the left, we've got assets. On the right, liabilities. Then we have the commercial banking system, an aggregate total of their assets, liabilities, and then the average Joe. All of you watching this video right now, the average Joe and Jane. So let's think about this. Your dollar assets, or your quote-unquote cash, that's a liability of the commercial banking system. So let's just assume for a moment the Fed takes their balance sheet to 10 trillion, 20 trillion, 50 trillion. Does that mean that you are definitely going to have more dollars in your bank account? I don't think so. My point is, when the Fed does quantitative easing or increases the size of their balance sheet, they're just buying treasuries or mortgage-backed securities from the banking system, and they're using bank reserves, fugazis, that they create out of thin air to buy those assets. So as my good buddy Jeff Snyder says, it's simply an asset swap. Now, this would make a difference if this increased the bank's ability to lend, but it doesn't. Editor, go ahead and throw up a chart of bank reserves in the United States, and we can see that prior to the GFC, it was around 40 or 50 billion with a B. Now it's over $4 trillion. So there is no constraint on the banking system whatsoever to create an additional loan for, say, $1 million or a business loan for $100 million. They are not constrained by their balance sheet or the amount of bank reserves at all. So if the Fed increases their balance sheet, again, to 20 or 50 trillion, it's just them pushing on a string. It doesn't necessarily mean that the banks are going to create more loans, which would mean that there were more dollars on the balance sheet of the non-bank entities in the real economy, which were circulating, chasing goods and services, creating inflation. So this is the first mistake that Cathie Woods made. And again, it illustrates my belief that she really doesn't quite understand the dollar monetary system, and she definitely doesn't understand how the Fed's balance sheet interacts with the commercial bank's balance sheet and the balance sheets of the average Joe and Jane in the real economy. But unfortunately, her mistakes don't stop there. Let's look at a chart of velocity. This goes all the way back to 1970 to today's date. And actually, I've gotten very creative here. I've combined the chart of velocity with the CPI, the rate of inflation as measured by the government. Now, I know this understates inflation dramatically, but just for the purposes of this video, this measurement will work well. So on the left, it goes from 1 up to 2.2. This is the ratio for velocity, those dollars circulating in the real economy. And then on the right, this is the measurement for CPI. It's an index, goes from 0 up to 280. So what's interesting to note right off the bat is that during the 1970s, velocity was very consistent, but yet we had extreme levels of inflation. So if velocity is the be-all, end-all, how on earth did we get so much inflation back in the 1970s when velocity was consistent? Also, let's look at what happened to velocity in the 1990s. It skyrocketed. What happened to inflation? Pretty much stayed on its historic trend. Then, during the dot-com bust, velocity goes down even further during the GFC, and it absolutely plummets during the cerveza sickness. But notice what happened to consumer prices then. Yes, they notch down slightly, but then they go way up. So just from what we've seen in 2020 and 2021, when velocity has fallen out of bed, but yet prices have skyrocketed, it debunks Cathie's belief that velocity is really the important metric when we're trying to figure out the probabilities of inflation or deflation in the future. But let's take it one step further so I can explain to you why there really isn't a correlation between the way velocity is measured and the way inflation is measured. Let's start by looking at the formula. Very simple. Velocity equals GDP divided by M2 money supply. But let's think about this. What happens if you can't quantify M2, or you can't quantify quote unquote money? Or maybe better said, you can't quantify the amount of dollars that are in the private sector. Now let's remember what Jeff Snyder teaches us about the Eurodollar system. And that is, there's only a small percentage of dollars that are actually under the purview of the Fed that can be seen. And there's a large percentage of dollars that are unseen. They're in the shadows. And this is what the Eurodollar system is all about. So let's just assume for a moment this pie chart represents 100% of the dollars that really exist under the purview of the Fed and in the shadows. And that M2 is about 25%, and what's in the shadows is 75%. Well, if there's a 10% increase in M2 money supply, yet there's a 5% decrease in the amount of dollars that are in the shadows, in aggregate total, has the amount of dollars decreased or increased? You see, the amount of dollars has actually decreased. So how would that affect this formula? If you're using a 10% increase in M2 money supply to determine what velocity is, but in reality, there's a 5% decrease, your number is going to be way, way off. And I think this is potentially what happened during the 1990s. According to the Fed, M2 money supply stayed the same, but yet GDP really went up. Therefore, they thought velocity increased dramatically, but was it velocity increasing dramatically, or were there just more dollars that were being created in the shadows? I don't want to give Cathie Wood too hard of a time here because this is a very common mistake and very few of the experts even understand what I'm talking about or what Snyder talks about with the Eurodollar system and all of these dollars that are in the shadows. But if you're really putting all of your eggs in the velocity basket, it shows that you definitely don't understand this system and you don't understand how dollars are created or where they even exist or the Fed's ability to quantify them. The second part of her argument for prices going down in the future is that we have this deflation feedback loop. You hear this all the time from the economists and the talking heads in the mainstream media. And it's one of the biggest fallacies in economics. Editor, let's cut to the internet. This is from a recent CNBC article. She says the costs of prices decline, velocity and disinflation, if not deflation, follow. If consumers and businesses believe that prices will fall in the future, they will wait to buy goods and services, pushing velocity and money down. Or maybe better said, pushing prices down even further. This idea is incredibly simple to debunk. Let me ask all of you watching this video right now, how many of you are going to not buy gas the next time your tank is empty because you believe the price of gas will be lower in a month? How many of you won't buy food tomorrow if you're hungry because you think the price of food is going to be lower in a month? How many of you wouldn't pay rent this month because you thought the price would be lower in 6 months? The bottom line is, if what Cathie Woods is saying was true, then no one would ever buy a new car because you could just wait a year and that same car is going to be a lower price. No one would ever buy a cell phone. No one would ever buy a computer. No one would ever buy a camera like the one I'm using to record this video. It doesn't make any sense. The only thing that people hold off to buy are assets. If you think the stock market is going down by 50%, you're going to hold off to buy it until the price goes down. Same thing with Bitcoin, same thing with gold, same thing with real estate. So that may be true with asset prices, but it has absolutely nothing to do with consumer prices. Her third argument for deflation is the influence of technology. That we're going to have so much automation, so much artificial intelligence, self-driving cars. Google's going to change the world, and prices are just going to go down further and further and further because of all of this incredible innovation that we can't even comprehend right now. And oh, by the way, all of this is going to happen right after Christmas. This is according to that CNBC article. Or we're going to start to see the effects of it after Christmas. But again, let's just think through this for a moment. The CPI is measured with 20 or 30% of the weighting going to housing. And it's not just the price of houses, it's owners' equivalent rents. So how on earth is technology going to drive down the prices of rents? The answer is it's not. We build houses today pretty much the exact same way we built them 20 years ago. And we built them 20 years ago pretty much the exact same way we built them 20 years prior to that. So you're dealing with a business that is very, very low tech, and it's almost impervious to quote unquote innovation. And that represents the largest portion of the CPI number. And let's not forget energy prices. According to Cathie Wood, those are going to come plummeting down because we're going to get all of our energy after Christmas from the sun or from wind or maybe from waves or something like that. Now, this is a great idea. I'd love to see it. But the bottom line is before we get from here to there, we're going to go through extremely high energy prices of fossil fuels like nat gas, coal. We can see this playing out right now in China and in Europe. They have shortages of energy or these fossil fuels they use to create electricity, and therefore the prices are skyrocketing. Therefore, regardless of how much innovation you get, it's going to be a long time before we can power the entire globe on wind or solar. So in the interim, energy prices skyrocket, which is definitely not deflationary. In fact, it's very inflationary. So I think we can safely say Cathie Wood is wrong about deflation, especially just when you look simply at the CPI and see how much deflation we've had since 1970s, almost zero. So the probability of us seeing extreme deflation in the future, very, very low. So I think Cathie Woods is wrong, but it doesn't necessarily mean that I think Jack Dorsey is correct. Let's go ahead and explore that further. Step number 3, is the United States Weimar Germany 2.0? In step number 2, we figured out that Cathie Wood is most likely incorrect. I understand there are no certainties, only probabilities. The probability of us experiencing consumer price deflation to a significant degree right here in the United States anytime soon, in my opinion, is extraordinarily low. So sorry about that, Cathie. I know you love tech, but this time I think you're wrong. So then the question becomes, what about this guy holding the sign saying, I love crypto? It's Jack Dorsey himself. You can tell this because he's got a nose ring right there. Very fashionable, I may add. But is Jack Dorsey correct? Well, let's go back to the chart that we looked at in step number 1 of Weimar Germany's hyperinflation, the mark relative to the price of gold. Remember, they saw inflation from 1919 to 1920. Then it kind of flattened out in 1920, 1921, and then it went absolutely parabolic. One of the catalysts to it going parabolic, what we saw in 1923, was something called Gresham's Law. We talked about that in step number 1 as well. But to get some insights as to how this phenomenon may play out right here in the United States, let's cut to a clip of an interview with Dr. Lacey Hunt and my good buddy, the bond king himself, Mr. Steve Van Meter. And Steve, just a heads up, buddy, going to see you in Miami in a couple weeks. First beer's on me, buddy.
So the Fed can facilitate the increase in debt, but it's not the spender of last resort. Now, there are a lot of people that are saying, well, let's make the Fed's liabilities legal tender, medium of exchange. That would then destroy the system. You would then get hyperinflation. As long as we have the current system and you take on more and more debt, you're just going to grind down. If you modify the system to coordinate monetary and fiscal policy more, you'll go into the inflationary option.
Notice what Dr. Lacey Hunt was saying. If the government continues to deficit spend monetized by the Fed, we will most likely stay in this environment of inflation, bits of disinflation, back to inflation. He thinks we're going back to the banking system creating the majority of the dollars. Therefore, this would be deflationary because we have more and more government spending, even though they're sucking those dollars out, putting them right back in. It's distorting the economy, creating less dollar-denominated cash flow to service dollar-denominated debt. And the rate of velocity, although we're not using that as a measurement, the rate of velocity goes down. This creates tremendous deflationary pressures. More on that in just a moment. But then he also said that he would go from having a deflationary stance or view of the United States to a hyperinflation view if the Fed turned their bank reserves into legal tender. So what happens right now, those dollars that you have as assets on your balance sheet, those are liabilities of the commercial banking system. But if you had an account with the Fed, i.e. central bank digital currency, then those bank reserves the Fed can print, the Fugazis out of thin air, they could just credit your account with $1 trillion, and then you would spend them into the real economy as though they were legal tender. That's the line in the sand for Dr. Lacey Hunt. So to reiterate, because he is one of the foremost experts, I have a tremendous amount of respect for him. He's one of my favorites. If we go back to a system that we had before, he's in the deflation camp. If we stay in this hybrid system where the government is deficit spending to a great degree monetized by the Fed, we see kind of inflation like we've seen 2020-21. If the Fed turns their bank reserves into legal tender via a central bank digital currency, now we're off to the races with hyperinflation. But the main reason he goes from a deflationist to a hyperinflationist is because of Gresham's law. So we understand how that would work domestically in the United States. We went over that in step number 1. But how would that work outside of the United States? Because the US dollar is the global reserve currency. It's about 50, 60, maybe even 70% of global transactions are settled in the US dollar. So if we're trying to figure out the probabilities of hyperinflation, we've got to consider the domestic economy, but we also have to consider the global economy. Let's dive into this whiteboard visual and I'll explain what I'm referring to. So we know that inside the United States, prices going up or down really about supply of goods and services and demand as measured by the amount of dollars that are circulating in the real economy. I always like to focus on the dollars on the non-bank entity's balance sheet in the real economy because those are the dollars that really get out there and circulate chasing the goods and services that are measured in prices. So if we have a lower supply of goods, then we're going to see prices go up, all things being equal. Or if we have an increase in the amount of dollars, same supply, then we see prices go up as well. But let's think about what has happened since the cerveza sickness. The amount of stuff we produce in the United States has gone down, but the amount of dollars has increased. Therefore, we've got to get the goods from somewhere. So we import them. That's why the trade deficit is at all-time highs. But if we're importing goods, what are we exporting? We're exporting dollars out into the global economy. For a moment, I want you to imagine that there was just one corporation in the entire world that provided the goods for all of the countries. So we'll call it Megacorp. So when the United States needs goods, they import them from Megacorp. They're the producer. We send Megacorp the dollars. Well, the Chinese import goods, the Australians import goods, and so do the Colombians. All countries do. And let's remember, the majority of these transactions will most likely be settled in US dollars, even if it's not their local currency. So when China imports goods from Megacorp or Australia or Colombia, Megacorp sends them goods, but these countries send them dollars for things like commodities, let's say, that need to be settled in dollars. And they also send them their local currency for goods Megacorp will accept in their local currency. So let's also remember that Megacorp has a balance sheet. Now we're going down here. And they've got a lot of debt on their balance sheet. Their balance sheet is massive because they are the only business in the entire world. But they've got a lot of dollar-denominated debt, even though they are domiciled outside of the United States. So they're taking all of this dollar cash flow they're getting from selling these goods to not only the United States, but other countries, go down, they deposit them, they're now assets on their balance sheet, and they can use them to pay down their dollar-denominated debt or service the debt payments. Now, this dollar-denominated debt that's a liability of Megacorp is an asset of a bank. Let's say this is a bank domiciled outside of the United States in the euro dollar system that can create dollars by lending them into existence, just like the banks in the United States. Well, what happens if we go into a global lockdown, let's say, where the amount of goods that Megacorp can produce decreases dramatically? Well, that means that their cash flow, the dollars that are going into Megacorp, decrease dramatically as well. Well, if they have fewer dollars coming in, then they have fewer dollars to service the debt. And this could lead to a default. So what does that do to the value of the dollar outside of the United States against other foreign currencies? Now, if you guys are really paying attention, you would say, well, George, not much, because that doesn't decrease the amount of dollars that are circulating around the globe. And you would be correct. But let's think this through. To illustrate my next point, I've got a doom vortex, or as my good buddy Raoul Paul says, a doom loop. And it starts with dollar-denominated cash flow at the top. If that goes down, then you're going to see defaults on the bank's balance sheet, those loans they have. Those defaults are going to increase. So that means the assets on the bank's balance sheet denominated in dollars decrease as well. Well, this reduces their balance sheet capacity, or BS, if you prefer. And since their balance sheet capacity decreases, their ability to create more dollar-denominated loans or liquidity that Megacorp needs to survive in the future decreases as well. If there's less dollar-denominated liquidity available because reduced balance sheet capacity, that increases the likelihoods of more defaults in the future, going back to the real world where there's multiple businesses. And if we have more defaults, then that means that there's less dollar-denominated cash flow going to, now we'll fast forward to the example, back to Megacorp, and this cycle just feeds on itself. It's a feedback loop that gets worse and worse and worse. There's fewer and fewer dollars in the system. Therefore, the demand for the dollars increases dramatically outside of the United States, even if the prices of goods and services inside of the United States is increasing. I also want to point out the fact that dollars are lent into existence outside the United States, just like inside the United States, the way they're usually created without this hybrid system of the government deficit spending and the Fed monetizing or moving to a central bank digital currency. But usually inside the United States and outside, 97% of the dollars are created by lending them into existence. Well, think this through. If they're lent into existence, that means there's principal plus interest. So at any given time in the global economy, there's more dollar-denominated debt than there is dollars to pay off the debt plus interest, or the principal plus interest. So how does this work? Well, it goes back to velocity. Not from a standpoint of measuring it, but if you have enough velocity in the global economy, then you can pay off $20 of debt with only $10. But if the global economy is in a slowdown due to all of these government interventions, and again, it's not because of the cerveza sickness, it's because of the global government's response to the cerveza sickness. But that decreases velocity. So if you're decreasing velocity, that just adds fuel to the fire of this doom loop we talked about earlier. So in that situation, what would the corporations, or in this case, Megacorp, do? Well, they'd have to sell their assets. This would include the local currency that they're getting from all these other countries that they get monthly or they have on their balance sheet. But it also includes dollar-denominated assets they have in the form of things like treasuries or stocks. So if they went ahead and sold their treasuries, as an example, well, then they would take dollars, most likely from a domestic entity in the real economy. But what would they do with those dollars? They'd use it to pay off debt. Well, when you pay off debt, what happens to those dollars? They're gone. So let me review this just to make sure we're all on the same page here. If Megacorp sells some dollar-denominated assets, let's start with that example, then those dollars are going to go to the bank. Well, the bank is simply going to reduce the loan size, so those dollars no longer are liability on any bank's balance sheet. Therefore, the amount of dollars that exist in aggregate total decreases. Got it? Okay. Now let's think through what happens if they sell that local currency. Well, they're going to sell it into the global FX market to buy dollars. So that means the supply of their currency goes up, the demand for dollars goes up, therefore the price of dollars relative to that other fiat currency increases. But this isn't where the story ends. In this scenario, remember, there's fewer goods that are being produced. Well, if the United States has to import almost all of the goods it consumes, that means there's fewer goods to come into the United States. Then you get supply shortages, like we're seeing right now. Well, if those supply shortages increase in the future, which I think they most likely will, and they would if this scenario plays out, then the supply goes down. Well, what is the Fed going to do and the government? They're going to spend more money. So you have supply going down, you have demand, or the amount of currency units inside the United States, actually going up. So you get into this weird world where we're seeing significant price inflation in the United States, while at the same time the dollar is going up against other fiat currencies in the global economy. And for those of you who are really paying attention, you're probably saying, yeah, George, I get it, but the Fed could always create a swap line like they did in 2020. And you would be correct. They most likely would try to implement swap lines, but just think about that for a moment. Just because they implement a swap line doesn't mean those dollars go directly to Megacorp. That just increases the balance sheet capacity for the banks themselves. They still have to lend those dollars into existence. And if Megacorp is failing, they're not going to lend them dollars regardless of their balance sheet capacity that was increased by the Fed creating the swap lines in the first place. The other thing they could do is just print dollars to buy currencies on the global FX market. That would stop the dollar from going up. So we'll have to pay a lot of attention to this moving forward if we go into this environment where the dollar is going up to 110 or 120 on the DXY. So what am I saying? What's my overall point? Well, first, I wanted to explain this to you because very few people understand how this works. But second, I wanted to point out this is very complex. There are no easy answers for complex questions. So it isn't just a matter of, yes, we're definitely going to get hyperinflation. The probability, in my opinion, is extremely low until we get to a point where there is less dollar-denominated debt throughout the world. Well, how would this play out? Well, in order for there to be less dollar-denominated debt, there would need to be fewer transactions settled in dollars. Let's go back a couple months and remember what happened in Afghanistan. Well, that was a military debacle. I'm not going to go into that. But if you're Saudi Arabia and we have the deal, the petrodollar, that just means that we're providing them military backing and they're agreeing to settle all of their oil transactions in dollars. This creates a lot of demand for the dollars and therefore a lot of dollar-denominated debt moving forward because companies like Megacorp that need that oil, they have to have dollars to begin with. So it's very likely that when they go to the bank, they're going to take out a loan denominated in the currency that they need most. But what's happened is now Saudi Arabia has gone to Russia and said, you know what, let's do a military deal with them. So in the future, the probability of Saudi Arabia selling all of their oil in dollars goes down. Maybe they'll sell 20% in rubles. Now, this doesn't really move the needle too much, but if you have other countries doing that, gradually what happens is there are fewer dollars being used to settle global transactions. There's less dollar-denominated debt that is needed, and therefore, in that scenario, Gresham's law can kick in because the dollars that are on the balance sheets of the entities outside the United States, they're going to want to get rid of those dollars. Those dollars come back into the US because there's no longer as much demand for them outside of the United States. And then you could go into a hyperinflation scenario. But let me be very clear. This isn't really a prediction. It's more of a thought experiment. I think my base case is the dollar remains relatively stable in the DXY, but we continue to get consumer prices increasing in the United States. But we're not going to get to hyperinflation until the dollar loses its global reserve status. And although we're seeing signs of the dollar lose its reserve currency status today, this process takes a long, long time to play out. So to answer the question, who is right, Cathie Wood or Jack Dorsey, I think they're both wrong. For more content that'll help you build wealth and thrive in a world of out-of-control central banks and big governments, check out this playlist right here. I will see you on the next video.